A private credit facing its biggest test yet, according to the Financial Times. Wealthy investors trying to pull out $20 billion from major players like Apollo, Iris and Blackstone in the first quarter, with growing anxiety over loans to private equity-backed software companies. CNA's Roland gives the lowdown on private credit, how it works and why you should care.
Jamie Dimon's stark warning about the private credit boom: when you see one cockroach, there are probably more. That fear is hanging over a market that promised investors high returns and regulators a safer alternative to bank risk. A private credit is lending outside traditional banks when companies borrow directly from private funds. It's backed by money from pension funds, insurers, endowments, and increasingly wealthy individuals. Over the past 2 decades, the biggest private equity houses have moved well beyond buying and selling companies. They have become major lenders too, and they've become massive. Apollo, Blackstone, Carlyle, and KKR together manage $3 trillion worth of assets, and it's up roughly from $800 billion a decade ago. Here's how it works. Investors put money into a fund. That fund lends to companies, and those borrowers pay higher interest. But many of those loans do not trade openly like public bonds. So prices are harder to verify. Valuations are often based on models rather than constant market trading, and outsiders get much less visibility into what is actually sitting on those books.
Private credit has not been tested in terms of, since it's really grown to be such a big part of our markets. Really all it saw was COVID, and COVID was such a short and period, and so much Fed intervention, liquidity thrown into the mix. So I think you do have to worry about the underwriting standards.
At first, investors were rattled by concentration risk. Nearly a third of some private credit loan exposure was tied to software firms, just as AI is starting to disrupt parts of that sector. Now investors are also alarmed by something even simpler. Everyone else seems to be worried too. Many of these funds typically allow only up to 5% of holdings to be withdrawn each quarter. Now, if redemption requests go higher, managers exercise their right to enforce the cap or to try to satisfy more investors, putting the fund under greater strain. And that creates a dangerous loop. Now, if investors think the loans are overvalued, they rush to get out early. And then it becomes harder for managers to convince the market those assets are really worth what they say they are. But here's the crucial thing. Failing private credit funds are not about to bring down the entire financial system. This is not 2008 all over again. A private credit is simpler, less leveraged than the mortgage-backed securities behind that crisis, and unwinds more gradually. But that doesn't mean there's nothing to worry about. The biggest concern is insurers. Some have invested in debt linked to corporate buyouts, and in some cases, they are now more closely tied to the private market firms arranging those deals. So this may not be another global financial crisis, but it could still become a slow squeeze on the wider economy. When a fast-growing market built on hard-to-test valuations start to lose trust, the damage could spread. Tighter credit, higher borrowing costs, weaker investment, and more pressure on the real economy. At a time when companies are already dealing with war, energy shocks, and uncertainty, investors need to watch their space. For CNA Explains, I'm Roland.